All right, let's fold fixed income into this conversation as well. Alix was talking about the 30-year Treasury auction. Pretty good demand for the 10-year auction as well. So February looking okay when it comes to the Treasury refunding itself. What is your read here on the supply that we're going to get this year and whether that demand will continue to show up?
Well, those 30 years that got issued earlier this afternoon are now, through the bottoms. And so we're seeing yields rising. We're seeing that creeping happening for many of those buyers that are continuing to experience losses. We moved from well under 4 in now, up to 4.15 on 10s. And I think the key thing to remember with the bond issuance dynamic is that it's going to be very hard to front run $500 billion of net new supply in Q2. And so it's every day what you're seeing is a weight on the bond market that's coming as that issuance comes. And remember that Q2 net issuance is going to be twice as big as Q1. So right now, the actual flow, the actual demand to borrow is not that bad. Just wait till Q2 when it doubles in size on net.
Sure, but we could have said that like in the fourth quarter of last year, and then the takedown actually went okay. What do you do in a market, though, where you come in every day and things look overbought, technicals do not look good, and we continue to grind higher? Like, how do you manage that?
Well, I think you got to look at the linkages that will either stop the economy in its tracks or keep it going. And we've got this income-fueled expansion, and in that environment, stocks can continue to outperform, particularly bonds, as income growth continues to finance spending, and we continue to get strong nominal GDP growth. That's a very resilient type of growth. This is not the debt-fueled growth of cycles past. This is a very this is a expansion that can continue for an extended period of time until we get enough tightening in the financial markets to start to bring down asset prices and slow the overall economy. So right now we're really in that sweet spot of strong enough growth without enough tightening, particularly on the long end of the bond market, to bring things back.
How high do yields have to go before you start to see it show up in equities in a bad way?
Well, I think we saw a little bit of a flavor of that last year, but we moved bond yields up to 5, and equities sold off, 10%, 15%. That's not that big a deal. Equities sell off 10 or 15% all the time. And so we're probably going to need to get bond yields up there and for an extended period of time before there's enough of a weight on asset prices in the real economy to really bring this expansion to a halt.
All right, Bob, really appreciate your joining us today.